It's a Tuesday morning. Mike is wearing his best suit, the one he saves for interviews. And for this day. He's been waiting 40 years for this day. He walks into the Social Security Administration office, sits down, folds his hands, slides his paperwork across the desk. "I'm 65. I'm here to retire." The clerk looks at the screen, types something, pauses, then she pushes a paper back across the desk. "Sir, full retirement age is now 69. Come back in 4 years." Mike blinks. She stands up, walks to the door, flips the sign in the window, 65, 69. No apology, no ceremony, like changing a parking sign. 5:47 a.m. Mike's alarm goes off. He reaches over and turns it off with a hand that already aches. He's 65 years old, and he just became 4 more years of someone else's math problem. That alarm didn't go off because he wanted it to. It went off because they moved the finish line. Again. Now let me do the math that nobody in Washington wants you to see. Social Security was designed in 1935. Life expectancy at the time? 61 years old. The system was never designed for you to actually collect. It was designed for most people to die before they got there. Today, you're expected to live to 78. That's 13 more years of checks the system never budgeted for, and now they're running out of money. Your money. Here's the number that should make your stomach drop. In 1980, the U.S. national debt was essentially zero in practical terms. Today, $37 trillion. That's not a typo. $37 trillion. And that money was borrowed to fund promises. Promises to you, to your neighbor, to your father. Except the check writer just declared bankruptcy and went home. According to the SSA's own Trustees Report, not some podcast, not some blog, their own internal document, the Social Security Trust Fund will be depleted by 2033. What happens the day after? Benefits get cut automatically by 23%. No vote, no warning. It's already written into the law, but here's the part they really don't want you doing the math on. The CPI, what the government calls official inflation, says 3.4%. But if you've bought groceries, filled a gas tank, or sat in a doctor's waiting room lately, you already know that number was built in a conference room, not a grocery store. Real inflation, measured the way economists calculated it before 1990, closer to 8 to 12% per year. That gap between what they report and what burns in your wallet every month, that's not a rounding error. That's a policy decision. That's the invisible tax, the one nobody campaigns on, the one that quietly destroys everything you saved while you were busy working. $100,000 sitting in a savings account today. At 8% real inflation for 9 years, $46,000 of purchasing power left by the time you try to use it. The other half didn't disappear. It was redistributed, just not to you. Let me show you someone you probably know. His name is Dave, 54 years old, lives outside Columbus, Ohio, makes $72,000 a year, has a good job, has a family, has been doing everything the financial advisors, the HR department, and every magazine cover told him to do. And right now, at this exact moment in his life, Dave is one unexpected medical bill away from a crisis he won't recover from. Let's open his books. $72,000 a year? Sounds like solid ground. It isn't. Federal tax, state tax, FICA, Social Security, and Medicare. Gone before Dave cashes a single check. $22,000. Vanished. Mortgage. House purchased in 2018 for $380,000. Monthly payment, $1,800. Total paid to the bank over 30 years, $648,000. For a $380,000 house. That $268,000 difference doesn't go toward equity. It goes straight into the bank's pocket. Dave calls it his biggest asset. I call it a 30-year wealth destruction contract with a front lawn. Health insurance, family plan, $780 a month. Deductible, $6,000. Before the insurance pays a single dollar, Dave is spending $9,360 a year for the privilege of still paying for his own health care. That's not coverage. That's a ransom note with a copay. 2 cars, both financed, $1,100 a month combined, groceries, utilities, gas, $400 a month. So, what's left? $190. $190 a month. That's not a financial plan. That's a man standing at the edge of a cliff every single month, hoping nothing goes wrong. And here's what makes it brutal. Dave is not behind. Dave is exactly where the system wants him, spending everything, saving almost nothing, too tired to question it. Now, 20 years of contributions, $87,000 sitting in there. His whole retirement plan lives in that number. At 8% real annual inflation, that $87,000 will carry the purchasing power of roughly $40,000 by the time Dave turns 65. And if Social Security automatically cuts 23% in 2033, Dave's retirement doesn't get delayed. Dave's retirement gets deleted, not because Dave was reckless, not because Dave didn't try, because every single rule Dave followed was written by people who had no intention of following them alongside him. So who built this? Who benefits when Dave works 4 more years before he can even apply? Follow the ownership. The people setting your retirement age own real estate, portfolios full of it. They want property values high. They own equities. They need markets climbing. They have private pensions that dwarf anything Social Security ever promised. They do not need the system to work. They need you to keep funding it while it doesn't. The median age of the U.S. Senate is 65 years old. These are people insulated from every single problem this video is about. They don't feel the $780 insurance premium. They don't lose sleep over a $6,000 deductible. They voted themselves pension packages that would make your 401k look like loose change in a cup holder. And they are the ones who decided that 69 is the new retirement age. This isn't left versus right. Forget the jersey. This is a gerontocracy, a system designed by people who already accumulated everything, to be maintained by people still trying to start. They have the houses, the portfolios, the guaranteed income. They have every reason to keep the current math exactly as it is, and zero reason to change it for Dave. Here's the anatomy of the betrayal. 3 cuts. Cut 1. The promise. Work hard, pay in, retire with dignity. That was the contract. 40 years of your labor, in exchange for security at the end. Cut 2. The delivery. They spent the trust fund. Not invested, not protected, spent. On wars, on bailouts, on budgets that bought votes and buried receipts. The money you paid in for 4 decades is gone, and their solution, their actual official solution, is to make you wait longer. Cut 3. The silence dividend. Every extra year you work, you pay more FICA into a system circling the drain. Every year you delay collecting, the liability shrinks. Your exhaustion is not collateral damage. It is a revenue model. They don't need you angry. Angry people organize. They need you tired. Tired people comply. Here's what changes when you see it clearly. The sheep accumulates paper, cash that inflates away, bonds that lose to real inflation by 4 points a year. A 401k managed by someone charging fees to watch it slowly drown. The wolf accumulates what cannot be manufactured on demand. The government has a money printer. It does not have a land printer. It does not have a world printer. It does not have a time printer. That is the entire playbook. The wolf is not chasing a bigger house to impress a street. The wolf is not financing a truck to feel successful at a red light. The wolf has made a different calculation entirely. Status is rented. Cash flow is owned. Dave is asset-rich on paper and cash-poor in reality. His house costs him money every month. His cars bleed value from the moment they move. His retirement account loses purchasing power while the market throws a party he wasn't invited to. The wolf builds things that pay, not things that look like wealth, things that produce it. assets that generate income whether the wolf is working or not. That's not a number in an account. That's a different relationship with time. That's sleeping through an alarm because you chose to. That's the first morning in 30 years where 5:47 a.m. means nothing. That's what this is actually about. 3 moves, sequence matters. Step 1. Find the hemorrhage. You cannot build anything while you're bleeding out. Pull every statement, every recurring charge, every loan minimum, every advisory fee. Now convert each number into days of your life, not dollars, days. That $1,100 car payment on a $72K salary, that's 11 days of your life. Every month. To drive a depreciating machine, that 401k management fee sitting quietly at 0.8%, run it forward 20 years on $87,000, that's over $18,000 extracted from your retirement in fees alone, silently, legally, while they send you a quarterly statement and call it service. The bleeding has to stop before anything else matters. Step 2. Trade paper for tools. A savings account is not a safe, it's a slow leak. A bond returning 4% against 8%, real inflation isn't conservative. It's a loss with paperwork. The wolf reallocates into assets with 3 characteristics: limited supply, income production, inflation resistance, things that existed before central banks and will exist after them. Use the credit infrastructure they built against them. Use the rate environment they created against them. Accumulate what they cannot replicate with a policy decision. Step 3. Build the den. The den is not a number in a retirement account. The den is a structure, an architecture of income that runs independently of your employer, your government, and your age. Rental income, a business with systems that don't require your daily presence. Dividends from real, productive assets. Whatever the form, the function is the same. The day your income no longer requires your time is the day you retire, not the day a government clerk updates a sign on a window. The day you decided. That is the only exit from a system that was never designed to let you leave. Dave set his alarm for tomorrow. He doesn't know what you know right now. He'll keep doing the math, keep coming up short, and keep assuming the problem is something he did. It isn't. The rules were written against him before he started, and the people who wrote them have never lost a night of sleep over his $190. Now you've seen the architecture. You know what the Ponzi scheme looks like from the inside. The question is, what you do with that. I want a straight answer. Do you still believe you're going to retire on this system's terms? Or have you already decided it's broken beyond repair?